Charlie, can you provide an overview of the current tax landscape for businesses in Canada in the coming year?
Yeah, so there was some quite big changes announced in the budget 2024. I think everyone heard about the key difference being the changes in the capital gains inclusion rate from 50% to 66.7% for any amounts over $250,000 personally. But that's actually applicable if you have a corporation, it's on any capital gains income. So that's quite a significant difference, and it's kind of a move backwards to higher taxation rules. The other changes that were announced and that are probably coming into force are related to tax compliance. And that's going to be the most significant difference for businesses in Canada when they're dealing with CRA, because the various rules that are being put in place provide CRA with significant new powers, including the power to change the limitation period for reassessments. There's something called the normal reassessment period, and the changes allow CRA to essentially defer the start of that period, which is obviously a very, very significant power that we're giving them. In addition, there are rules being put in place that answers given to CRA during the audit process are actually going to be provided under oath. And that's a big change as well. And so I can foresee a lot of changes in the sense of CRA using that new power to take advantage of unrepresented taxpayers at the very beginning of any sort of tax dispute before a tax law is even involved. So people have got to be very aware of those new powers.
What are the most common tax compliance challenges that Canadian businesses are facing this year?
So one that I've had come through my door a lot recently in the past 4 to 6 months is builders of homes having issues with substantial renovations and HST issues. That is an issue that people seem to be falling afoul of continuously. And the other issue is changes to compliance measures and providing CRA with significant new powers that I can see they're going to start using very soon. And just the usual compliance problems, lack of documents, inability to respond to audit questions, and CRA officers not understanding the businesses that they're auditing. That's a common issue that people continually come up against.
Have you noticed an increase in tax audits or investigations by the CRA?
Anecdotally, I have, yes. I don't know whether that's statistically, but I have seen more audits occurring. I'm being approached fairly early in the process more often this year. I think there was a bit of a lull during the COVID period, and that lull ended after the CRA announced that they hired a couple of hundred new auditors. And so I've had two major things coming through the door. The first one is the eligibility criteria for the CERB and CRB and the various other benefits seem to be being crawled back at the moment by CRA, and there's a lot of decisions being made that to me make very little sense. So that's one thing I've been dealing with a lot. And the other thing is there seems to be a project going on for owner developers of buildings, and that's actually consistent with a number of the changes that were made in the 2024 budget with respect to building homes.
What are the most effective resolution strategies when businesses encounter tax disputes with the CRA?
That really depends on the dispute with CRA. I'll give you two examples. So with respect to an audit, whether it's a principal residence exemption, it's really a yes/no question. And so the effective strategy is that you go straight to tax court as soon as possible, because CRA, they see an opportunity to assess income, they're going to take it, and it's unlikely that you'll be able to dissuade them from that during the audit and objection process. It usually takes evidence from the mouth in front of a judge, and because it's a yes/no question, it's a 50-50. And so CRA will always basically disagree with the fact that it was a principal residence. The other situation is, for example, business expenses. They come into your business and they say, prove the $200,000 of expenses. That's a completely different kind of dispute because it's to do with documents, and there's a number of ranges of numbers that can come to. And so that might be resolved during the audit and objection process. And so it really depends on the case and the dispute. And depending on the situation, you should really be contacting your tax lawyer for an overall strategy that should be employed depending on that dispute.
What proactive tax planning strategies would you recommend for Canadian businesses?
Retain a tax lawyer and retain a tax accountant and have them look at your business and come up with a plan. There's no one shoe fits all strategy. If you're a landlord, you generally have passive income. There are different considerations. If you're running an active business, you have active income. There are other considerations. Are you big enough to incorporate? There are a number of variations and factors to take into account, and a long-term strategy should be put in place with a tax lawyer being helped by a tax accountant.
What potential tax issues or legislative changes should Canadian businesses be prepared for in the coming years?
I think the biggest change that we're seeing right now is the change in the capital gains inclusion rate. It's going to have a particularly large impact on landlords. And depending on the structures they already have in place and how the land is being held, whether it's in a corporate vehicle, a partnership, or a trust, or whatever the vehicle there is, they're going to have to get advice on potentially restructuring and the initial tax impacts on that. And it also impacts the economy in a broader sense, because people who might have been invested in land, suddenly they're paying about 10% more than they were. And it's going to take them, say, nine odd years at a 5% return to actually break even because of that change. And so a lot of people are going to be reevaluating where they're invested. So I think a lot of businesses have to look at this from that perspective in terms of the numbers. Does it still make sense long term to be a landlord? Does it still make sense to be invested in REITs? There are a number of questions that people really have to look at because of this quite fundamental change.
To wrap up, what are the top 3 best practices you would recommend for businesses to stay compliant and optimize their tax strategies in Canada?
With respect to compliance, I would highly recommend having a good bookkeeper that you can rely upon to get your books done on a monthly basis and stay up to date. That avoids 90% of the issues people run into with CRA. Combined, especially when you combine that with a chartered accountant that you can rely upon. Number 2 is retain a tax lawyer to provide you advice on overall structures and optimization. Should you be a corporation? Should you be a partnership? Should you be a mix of both? Those kind of questions can be answered by a tax lawyer. And number 3 is sign up to our newsletter.